Hi, it's Larry McDonald with the Bear Traps Report. I wanted to bring in an old friend, veteran trader, mentor to me over the years, Herbert Seelust III. And we're just going to have a nice conversation. We're calling this Conversations with Veterans, having a little coffee. We're here in Panama, enjoying the sun. Nice to be in Panama in February.
True.
But really appreciate, we want to give something back here as we head into the weekend and share some lessons from the last couple of weeks of this year, and then also looking back over a career of trading lessons. But Herb, we were talking about this week Marty Zweig.
Yep.
And you had a move over the last 3 weeks. Global rates.
Yep.
So big move up in global rates. Credit weakness in the U.S. as a regard to the ECB tightening policy, and then inflation proving itself to be even more sustainable.
Correct.
How would Marty look at that?
Well, Marty's had a lot of principles. His two biggest were don't fight the Fed and go with momentum, don't fight against momentum. But his third big principle was to pay attention to high yield. He viewed high yield as a leading indicator for a stock market, and his fourth was global stock markets in general. You don't want to be a lone horse. So he would be looking at this and say, well, let's see, the Fed looks like it's going to be tightening,
Yep.
So don't fight the Fed. And momentum's gone. I mean, there's no way you could, maybe it's not crashing, but it's hardly rallying every day like it used to. So momentum's evaporated. High yield is rolled over. And you see that not only in domestic high yield, but over in Europe in particular. The crossover is down hard, which is to say that spreads have widened out and are now trading between a 300 and 330 range, which is 10 to 20% wider.
Crossover is in Europe.
Well, crossover is tend to be slightly better credits than high yield in the U.S., but it has a lot of exposure to risks that the U.S. doesn't have, such as Italy, such as Greece. And one of the reasons why the crossover index is performing a little bit worse than the U.S. is because of fears about what a higher rate regime will do to those two countries.
And negative yielding bonds this year have gone from about 11 trillion to 4 trillion.
Right.
This year.
Yes, it's really amazing. Well, the thing is that convexity measures the price change per basis point in a bond, and when you get to cross the zero threshold in negative territory, the curve of convexity is almost vertical. So
let me explain. So when you go from minus 20 basis points, minus 50 basis points in yield, to all of a sudden plus 1 or 2 basis points.
It doesn't sound like a big deal, but in terms of dollar price, it can be huge. So on a long-dated bond, if you're going from 1% negative to 1/10 of 1% positive on certain bonds, that could be 20 points. So the carnage is phenomenal in negative yielding, that in terms of absolute dollars and price action. It's pretty impressive.
And that can have follow-on side effects.
Well, as wealth,
credit.
the problem with wealth destruction, see, most people think that somehow if money goes away in one part of the world, it somehow shows up in another part of the universe. And the answer is no, it's just destroyed. It just goes away. And that's one of the problems you're having in the markets, is just outright loss of capital.
Now this week, the Apollo News, we run a Bloomberg chat with about 650 institutional investors, and they're in over 23 countries. And one of the things that this week, especially later in the week, people are talking about deals. So the new issue market in high yield has been very strong in the last year. And I've noticed a couple of veteran credit traders that were extremely bullish high yield all last year, even in early January, have flipped pretty violently. And in terms of getting deals done, we've had some, not so much hung deals. We're talking about new issues here in the high yield market, but deals that have had trouble getting done and getting repriced at different levels.
Well, what happens is that at the height of a bull frenzy in high yield, it can be the worst bonds in the world get done, the worst debt deals get done, covenants fall by the wayside, and there's a reason for it, which is there's tremendous pressure to invest because so much capital has been raised in the space. And yes, it's true that initially the first deals that get yanked are pretty lousy deals, But the point is, 6 months ago, they weren't getting yanked. They were getting heavily renegotiated, et cetera. But they weren't just outright saying, okay, we'll come back to another time when, quote unquote, market conditions are permitting. So, of course, by definition, when credit rolls over, it's not the good deals that are failing to get done initially, it's the worst, and then slightly worse, and it keeps on going. So I think you're beginning to see a certain amount of selectivity where it used to be the issuers of control, and it's beginning to happen very, very early stages where the buyers and investors are beginning to get control in that sector of finance.
And then what happened on the Apollo deal?
Well, so Apollo just announced today that they're delaying a financing of a transaction that they're involved in because they were meeting investor resistance. So.
Okay, so private equity. In your career, what are the telling signs of private equity? Number one, obviously, when they come to market with a lot of paper, they're the best sellers in the world.
Best,
right?
the best.
And so they were very aggressive selling inventory last year, especially in the third, fourth quarter. Also some insider sales, so there's two elements to it. There's them selling their private equity, bringing it public, but then they're also, I guess from what I understand in the chat, from institutional investors, they've been extremely aggressive. A number of private equity holders of selling their own stock.
Right.
I mean, what's your take?
Well, what's really interesting about that is that theoretically, if you were having this conversation 6 months ago, all you would be hearing about is how much cash private equity firms had to invest. And therefore, the stock market would never go down. So why are private equity guys selling? They already have a lot of cash. That makes no sense.
Yeah.
So apparently, they know how to buy low and sell high, and it doesn't matter how much cash they got. If it's high, they're going to sell it. So I find it would be one thing if they were cash constrained, because then you could say, well, they need to raise the money because there's this other deal they want to do. They got more money than they know what to do with, and they're still raising more money, not just from new investors, but by liquidating old investments. So
Yes,
they obviously don't like the current environment per se. I mean, sure, there's certain deals in certain areas and all that, but in a generic way, they sense there's a deep bid that they ought to tag.
And in your career, looking back in the last 30, 40 years, when they get aggressive in a 6-month period, especially toward year end, what does that tell you?
Well, you see, the thing about it is, this goes back again to Marty Zweig. When he would see, in the old days, you would get Barron's hard copy, and you wouldn't read the articles. You would immediately go back to the last 10 pages where just a ton of stats. And one of those sections was insider sales transactions. And when it took up a large portion of the page, you started selling. Because they're like, wow, that's taking up a lot more piece of the paper than it used to. So it's time for me to ease out. So now you don't really have that as much, because before an insider was somebody who was on the board of directors or whatever. Now you have private equity. So when private equity is liquidating, that's equivalent to insider selling, and that's equivalent to people who know the most reducing risk. And you're kind of supposed to pay attention to the people who know the most.
Okay, so we have to start thinking about liquidity, because if liquidity is drying up, the Fed's pulling back accommodation.
Yep.
They've been offering up more and more accommodation. They still are offering the accommodation, but the breadth of the accommodation that they're offering is being pulled back. And now the street is talking about potentially 50 bips, 50 basis point rate hike.
Yep.
Possibly even eliminating quantitative easing immediately.
Yeah.
So going or more moving toward quantitative tightening very fast.
Yes.
So quantitative easing is when you're buying you're buying bonds. We were buying 120 billion a month as like 6-7 months ago, right? Now we're buying less, but quantitative tightening goes into a whole dynamic of actually reducing the balance sheet.
Well, I mean, the original idea behind quantitative easing was to push risk out the curve. So, and then the fantasy was that somehow that would stimulate lending, which of course it didn't for a variety of reasons. But it was viewed as a way of forcing people who needed to lend, needed to buy credit, to buy riskier things than they used to buy. So, and that's the whole genesis of the idea. because markets had seized up post-Lehman for along those lines. So by definition, if they withdraw that and reverse it, what they're asking for is for credit to become more conservative and for investors to become more conservative and for investors to become less aggressive. Well, more conservative and less aggressive means lower stock prices. That's just what it means.
Yeah.
And by definition, if you're widening out spreads on the debt level, that has to show up in the equity level. You can't, double the cost of debt capital, just take an extreme thought process and expect the stock to be unchanged. I mean, the weighted average cost of capital is a set thing, and if you increase the debt, then your equity cushion is just going to go down. It's just going to happen. So if initiating quantitative easing was asking market participants to seek more risk, then reversing it is asking market participants to seek less risk.
And if you think about it this year or the last 52 weeks, not so much this year, we've essentially had like a very slow-moving 1987 crash, not across the indices, but the tertiary parts of the market, whether it be ARC stocks,
devastating.
and AMC, but it started there, then it moved into software, then it moved into biotechs, and it feels like they're coming after the crown jewels. I mean,
for sure.
It's
Absolutely.
amazing how, it's amazing how the tertiary parts of the market were the first to actually pick up on the threat of the withdrawal of accommodation.
Yes. Well, I mean, first of all, when you say tertiary, if something's trading at 10 to 75 times sales, it may be tertiary, but it's also ridiculous.
Yeah.
So you would hope, it would go down. Now, the Fed probably has mixed feelings about this. Do they really like seeing excessive speculation? No. So if you said to the Fed 5 months ago, hey, I got a great plan for you. We're going to pop this bubble here, but stocks are going to be down like 5% overall. They say, that's fantastic. Yay, right? So I'm not so sure they're really upset about those sections of the market that were overpriced coming back home to reality. But that fits into the concept of they're asking people to take less risk. And Marty Zweig would listen to that request.
Yeah. So, October 1987, 87 crash. I'm with my dad in his brokerage firm. He was so busy, the market was crashing, and he said, Larry, get on the phone, and we have to sell 100 shares of IBM. So I called one of the traders at First Albany, and I said, I have 100 shares to sell of IBM.
Good old First Albany.
Yeah, good old First Albany. And he says like 86 bid. I said, well, my machine says 120. And he says 86 bid. I said, well, my machine says 120. He goes, well, sell it to your machine then. That was my experience with liquidity, my first experience.
There were a couple of people in some of the tertiary stocks you were talking about were wishing they had that machine also.
Yeah. But, what are your memories about liquidity, 87? You lived
Well, 87 is a very specific thing because the market had sold off pretty hard the week before and the Friday before. And I had managed to stop my customers out at the time. I was a retail stockbroker at a regional firm. But I had managed to get my customers out. I said, at the close, I said, there's no way this sell-off's going to last more than a day or two. So I actually stupidly bought right at the close. The opening tick on Monday was down 25%. And I was right. It was only going to last another day or two. In fact, it only lasted another minute. That was the low. But it was 25% lower. It just gapped down. It was shocking. The worst gap, and I remember very much saying, I'll put a 6% stop, because the worst down gap I had seen at that point was like 3.33%. No one had gotten 10%. No one imagined a 25% kick. And over the weekend, there was concerns at the time that Iran might blow up some ships in the Straits of Hormuz and all. So there was some geopolitical tension at the time also. But no one imagined 25. And I remember, even though my clients were out and I was the only one in, having to talk to clients to 10 o'clock at night, that was just a crazy day. It's a crazy day.
Well, you've always been a mentor to me because, you spent so much, I've rarely met anybody that spent as much time on the buy side as you and the sell side, all, pretty much through an institutional career.
Yep.
when I was at Lehman, our core wonderful group of people that we had there, they all look up to you. You trained some of the best distressed.
I fooled them all.
Christine Daly, who was head of our distress department, who's a big feature character in our book, A Colossal Failure of Common Sense, the inside story of the classic.
God rest her soul.
She's an amazing woman. Yeah, she was an amazing woman. And, the book's in 12 languages now. It was just voted one of the top 20 in the CFA Institute.
It's a great book.
It's a great book. And, you're a big part of that book in my mind because, you were, we talked all the time. You're a mentor to me. I probably couldn't have done a lot of these things without you and my Lehman mentors and Christine and Jane.
You would have been fine without me.
Yeah, I don't know about that. And Alex. But walk us through your career path and.
Well, I mean, my father traded commodities and stocks, and I remember those were the days when Bache and Blythe and Eastman were separate firms, and Merrill was just Merrill, and so he had a long bench where he kept all his stock certificates, and I would have to order his stock certificates, and he had another long bench where he had all these research reports. So I was kind of his secretary, and I would sort of order everything, put things in files and all that type of thing. And I remember holding, he always took delivery, I remember holding these parchments of the actual stock certificates and looking at the art logos and stuff like that. So I was always very, very intrigued and interested in that by definition. And then back in the old days when, and now I was a teenager, Arthur Miller was the Treasury Secretary at the time, and my father was trading treasuries, and he got me involved in that part of thing. And then he was a big bankruptcy investor, so I would go to bankruptcy court with him, again, when I was in my teens, and I would carry his attaché case, and he would sit on various creditors committees and reorganize the companies. And phenomenal profits back in those days, like just crazy money.
And your dad did a deal with Carl, right?
Yes, well, Carl Icahn's first deal was Bayswater Realty, and his comrade in arms, they were different shops because personal money, was my father.
Oh my
and when you would walk into Carl's office back in Katona, you would walk down the hallway and you would have certificates of all of his deals, and the first one you saw was Bayswater Realty.
Wow.
It's pretty funny.
In looking at markets today, I think one of the most important things going on right now is when you've been in a long bull market and the bear claws start to appear, and they've inflicted a lot of pain across a lot of stocks. At one point this month, I think greater than 35% of the NASDAQ was off 50% or more.
It was amazing.
So the bear's claws are out there.
For sure.
And so in measuring that, in measuring bear markets versus bull markets, and whether or not this is a buy the dip moment or if we move into a true, sell the rallies moment. How you look at the ARMS index, what are you looking at for indicators in terms of measuring the strength of the bull versus the emerging strength of the bear?
Well, there's short-term, there's long-term. And on the short-term side, yesterday was very, very interesting. Stocks were down and rallied back up and down and rallied back up again. And the ARMS index, or the trend index, was below 1, comfortably below 1, around half a point, which meant that, yes, there were more stocks down than up, and down volume was down, but not as bad as the number of issues. What was happening is in selected issues, there's some pretty heavy buying. And that's what made the ARMS index like that. By the end of the day, it had gone to neutral and was meaningless. People had given up. And of course, between those 2 points, you had various market events that changed people's minds. But one of the hallmarks of a bull market is that the close is strong. People are wanting to buy, and because they're thinking, I'm going to make money. I'm going to have a return of my capital plus a profit. So, and I really can't afford to wait till tomorrow. I need to buy now. In a bear market, what you want is you want your money back. So you can't really risk waiting overnight to get your money back. You may not have the chance. So it's 345. There's the bid. I can sell and get my money out. So bear markets tend to be weak at the close, and yesterday, hope gave way to sadness, and that was reflected in the trend. So that's on a short-term index. Longer term, Thurston, you've talked about this a lot. the advanced decline line has been going sideways like forever. I mean
Right?
it was not, yeah, exactly. It was not in any way, shape, or form, going in sync with the other averages, and it had. In fact, it had even gone up more and had led, but it totally topped out, and obviously one stock after another, new highs shriveled, new lows started creeping up, and all of that is a sign of distribution. So you were warned for quite a while that problems were brewing, that's for sure. And of course, inflation was already picking up that time, so there was obviously some kind of underlying concern about the cost of capital. Now, of course, it's front and center.
It's amazing that over the last 3-4 weeks we had that very brutal capitulation sell-off, the counter-trend rally. And what we noticed this week, especially in the Bloomberg chat with the institutional clients, we were ripping on equities, but high yield wasn't really buying into the equity rally.
Correct, and that's still the case. I mean, high yield is very, very, very skeptical, which brings us back to one of Marty Zweig's basic principles. High yield is just not buying into any kind of equity strength at all. They're clearly concerned, and the back has been broken. And I think what the view probably was, well, EU is not going to raise rates, so therefore high yield is going to seem kind of attractive, so there's a bid. Well, now EU is raising rates, and we don't really know where they're going to stop raising rates. It's barely begun. It's like a baby, right? It's not anywhere near an aged cycle or anything like that. So now you have real competition. And all of a sudden, you can buy product that yields. So for instance, imagine you are a UK pension plan, and you were living with all these negative yielding bonds around you. But you have a bogey. You got to come up with some jack down the road to fund all these pension liabilities that they do come due. You do have to pay them. Yeah. People need to eat after they retire, right? So you're going to chase by buying stocks, and that feeds on itself, and stocks go up, right? Well, now all of a sudden I'm looking around, and all of a sudden, lo and behold, there's $7 trillion of negative yielding debt that now actually has a positive yield. So what do I need to chase stocks for? By the way, 20 years ago, I didn't own that many stocks. Yeah. I was forced into this game that I didn't want to be in. And I can go back home to what I was trained to do, to my essential real self, and own debt that has a positive yield so I can fund a liability. So you're going to see, and I think this is spreading around the world, I think it's happening in the United States, just barely, literally fresh. You're going to see pension plans pulling out of the stock market and taking that cash and putting it into stuff that actually has a yield. And I think that's interesting because at this 2% bogey on the 10-year, I think the nature of the buyer is beginning to shift. So we'll see if that continues, but it looks like it's logically probable that you're going to see a rebalancing out of equities into debt as yields go up, because why wouldn't they?
And this year, or over the last year, it's so remarkable. Russia raising rates overnight, Peru again, Brazil, Mexico. I mean, we've had literally 100 rate hikes before the Fed's first rate hike.
As opposed to the last time.
Last cycle.
When they raised and it was a disaster for them, right?
Yeah, so some of the institutional clients have been saying over the last year that this is purposeful. The Fed finally got the joke. They blew up the global economy in 2013, leading out of the gate very aggressively with rate hikes. Dollar strengthened, the global wrecking ball obliterated the global economy in 2013, 2015, and 2018. Now the Fed is laid back purposefully and let Russia, Peru, Brazil, Mexico, South Korea all lead the charge here in terms of raising rates. The ECB is laid back as well, but we know gas prices in Europe are just, not just gas, but inflation as a whole in Europe is a problem. So it feels like the ECB and the Fed are both behind the curve.
Yeah, I mean, that is a possible explanation. The other explanation is it could be that the Fed just wants to lead from behind. I mean, these central bankers talk all the time.
Yeah.
I mean, certainly the reduction in rates as a result of the COVID lockdowns was coordinated. But all of a sudden, the increase in rates post-COVID going away is not coordinated? Maybe. But it seems to me it's probably coordinated. And if you gave Mr. Powell his druthers, he would say, I'd rather see the world raise rates and then I come in and raise rates instead of me blowing up the world, right? It's all a relative game. And don't forget, we're in a fiat currency regime, right? None of this money has any real value. So it makes more sense if you raise rates around the world. It's less disruptive for the Fed to raise rates. So if it feels it's going to be raising rates, it's at least thinkable that in these perpetual phone calls they have with each other, saying, it makes more sense for you all to do it. Don't worry, we'll be raising rates, and we'll be sending up trial balloons and all this type of stuff, but it makes more sense for the rising tide to lift all yield boats. So it's possible that they drop the ball, but it's also possible it's deliberate.
And when you think of, trading lessons through life, one of the things that I remember is living through the dotcom crash, and
that was a real crash.
Oh yeah, I was a younger trader, obviously in the '90s, and I was chasing a lot of the rallies. It was a greed market where I really, as the market turned over and went into a bear market, I found myself chasing rallies and then selling into capitulation sell-offs, chasing rallies, and because you want to believe that the bull market is still going on, right?
Sure.
And so you had these vicious counter-trend rallies in after the 1999 into 2000. You're heading into a bear market, but the counter-trend rallies were just absolutely incredible.
Always are.
And they suck people in.
That's their job.
And I think what I learned at Lehman, all of a sudden trading clicked for me, as I ran one of our distressed businesses, and I had a pretty good-sized trading book. And I'll never forget the moment when I really started to use my fears.
Key.
Using them, I tried to measure the fears.
Absolutely essential.
And I would use that to buy into capitulation sell instead of, chasing rallies and then end up being taken advantage of capitulation. In other words, I want to take advantage of capitulation. I don't want capitulation to take advantage of me.
Correct. Well, when you're a young trader, you trade with your emotions, and when you're a seasoned trader, you trade against your emotions. And
what does that mean?
And what that means is, when you're 25 and you're on a desk, you have this sense of fear, and so you sell. Or you see everyone's happy, and you buy. And, look, Dave Tepper is the greatest trader of his generation. He always says, when they're yelling, you should be selling, and when they're crying, you should be buying. Well, how do you know? Well, because you feel that. And what it is to say is, the herd tends to be right in the middle of a move, but at an extreme, they're always wrong. And your emotions, that's your primitive self. That's the herd in you. That's like, I'm the member. I'm just like everybody else. I have the same feelings. And that's wrong. So it's a valuable piece of information. It's like, my herd self is freaking out here. I'm really upset about this price action. And then your rational self comes in and says, that's you being like everybody else. You're supposed to be a contrarian. You're supposed to go, the real money is betting that they're going to change their mind. And so then you buy, precisely because you feel fear, precisely because that's what everyone has, precisely because that's what about. There's no such thing as an optimistic, joyous bottom.
Yeah.
And there's no such thing as a tragic, fearful top. Doesn't exist at all. So those emotions that you have are part and parcel of your humanity, of you being a member of your species. Everyone's feeling those feelings. The question is, do you fall prey to those feelings? Are you victimized? Or do you use them as a tool and a signal to make a more intelligent risk capital allocation?
I love it. That's a far better way.
And if I could do that, I wouldn't even be here. But nonetheless, it's true.
Well, over the years, that's helped me trade.
Yeah, you do great that way. You do great that way.
Larry McCarthy was another mentor of mine.
And he totally knew that.
And he was, I think, the last 20 years, probably the number one or number two junk bond trader on Wall
for
Street.
Sure.
But he always said, higher prices bring out buyers.
Yeah.
Lower prices bring
another
out sellers.
another classic line. Yeah.
And then size
very true.
opens
Very
eyes.
true.
Yeah, size
very
opens
true.
eyes.
Very true.
And that's what I'm looking for today. Is higher prices bring out buyers. Higher prices bring out buyers. Lower prices bring out sellers.
Yeah, but see,
Size opens
what
eyes.
really worries me about the market today is, this current period is, where are the body bags? I mean, one of the signs of a low is firms are shut down.
Yeah.
And the other sign of low is there are a lot of layoffs. So in the old days, the number one best indicator the bear market was over is Merrill Lynch would fire 10,000 people. As soon as you saw that, you bought blind. And then I'm talking like early 80s. You just bought. Now, I mean, where are the layoffs?
Yeah.
You know, and quite the opposite. You're seeing record premiums paid to get kids out of college. And God bless them, very intelligent. But I really don't think someone fresh out of college should be making 150 grand. I just don't. So, I mean, if they do, great. And I have sons out of college, and I hope they make 150 grand fresh out of college. But I really don't think that's like the right number for someone who, you know, barely knows how to tie their shoes. You know what I'm saying?
Yeah.
So that's a sign of a top to me, that this excessive drive for talent so that we can continue to grow. That's a top. You know, when they start firing people who are proven producers because you got to cut somewhere, that'll be a bottom. We are a long ways away from that.
Yeah. And, you know, in terms of managing risk in markets like this, and stop losses, and, you know, we have a capitulation model that measures, you know, 7-factor model that's
really
mathematically measures capitulation. What was the rule? You were you at Lehman Brothers? But that
Yeah, well, it was very funny. At Solly, what they had is if you had a loss for an extended period of time, sometimes it was a month, sometimes 6 months, but if you had a risk position and it was loss and you were holding on to it, you're obviously holding on to it, that was fine. You had to sell it, liquidate the entire position, and you had to sit on that cash for 24 hours. And then if you wanted to buy it back 24 hours later, you could. And it was like fixed. You know, you just got to tap on the shoulder, sell it, and you know you're all annoyed.
You have to sell it.
You have to sell
buy it back in 24
but
hours.
But after 24 hours has passed. So, and the fascinating fact is that 75% of the time those positions were never bought back.
Amazing.
And that was a fantastic risk management tool. And it showed that a very basic emotional thing, which is people hold on to positions hoping they can break even again. And that's why when people say technical analysis doesn't work, well, there's 1,000 different types of technical analysis. But the reason why horizontal lines and supply areas mean something is that when you break through that and you rally back up, people want their money back. And a classic example, and we'll see how it works, so you know, I can't see the future, but there's a clear horizontal line in Amazon. And it got up to that after these fantastic, marvelous, record-shattering results of whatever they were fantasizing about. They weren't that great, but everyone thought they were. Went right into supply, stalled, and backed off. Why? Because there are a lot of people there, like, relieved to get their money back. That's a bear market psychology.
Yeah. And so when you look for charts where you can see a very large pattern of supply, especially in markets like this.
Well, if you break down and you can see a lot of supply and you rally back in supply and you're worried about the market, you got to get out. But it works in reverse too, by the way, is why do people buy back at old prices when, you know, let's say you have a bottom, very clear trading range, you break out, you rally, and you come back to it. Why do people buy? Well, it's like they regret they didn't buy more. So, I can buy it again there? Fantastic, because you just spent a month ruining that you didn't buy enough when it was down there. So it gets down there, you buy. So it goes both ways. But now what you're seeing is people willing to break even. And that's just not a bull market.
And if you think of the fourth quarter of 2018, where the Fed was promising lots of rate hikes in 2019, and they were also promising $50 billion a month of balance sheet reduction. So they were promising both. And you remember, you know, the third quarter of 2018, as we headed toward this pullback and accommodation from the Fed, you know, high yield started to weaken, credit, but rates started to back up. Walk us through, you know, what you saw with the loan market, you know, say BKLN versus HYG and JNK, interest rate risk versus credit risk, and where we are now.
Well, I mean, it's all very similar because obviously you have to take that time and divide it up into moments. And the very early moments were pretty much identical. The problem is the inflation numbers aren't identical. And that sets up a very interesting debate, which is high yield then had a real yield after inflation. High yield today has a negative yield
After inflation.
after inflation. So, and that's assuming the inflation statistics we have aren't understated, which of course, I believe they're very vastly understated. So it seems to me that, the seduction of the 2018 paradigm is, well, that's how bad it's going to be. It's just going to get that bad, and then it'll reverse, and we'll have loose money again. Well, yeah, but inflation was nowhere near the same animal. The total amount of debt in the world, the total amount of debt in the United States was nowhere near as much. And they still had positive yields. That means there was a natural bid somewhere, right?
Yeah.
Not that far away. It felt bad at the time, but actually there is a bid, right? If you say, God, I've decided that I don't like high yield, and there's a collective aha moment that high yield is just ridiculous, it's just stupid because it gives me a negative return, and everybody, where's the bid? It's nowhere. I mean, it's like nowhere. Think about it. I have a current yield of 4.5%, 5% on a bond, right? And inflation is at least 10% really if you take real rates from rental rates and you fold that in. Where's my current yield going to be to match the rate of inflation? Well, it's not 98% of par. It's 65% of par. Well, that's equivalent to not being able to refinance your debt. I mean, it's shocking. So I really think the next distress cycle isn't really necessarily going to be companies going bankrupt. It's going to be like the old distress cycle in the 80s where bonds would fall out of bed but wouldn't necessarily go bankrupt. And they would trade in the 60s and the 70s. They would keep on paying their coupon, but the current yield became, no one cared about yields. It was like, stop. Like yields at maturity, fascinating concept, really care about it. I want to know what my current yield is because I know what inflation is. And that's all they talked about in the 70s. It was current yield, current yield, current. And they all knew what yield to maturity was. It wasn't like, oh, we don't know. But they know my money, over the course of this year, is going to have less purchasing power. I need to make up for that with money, not duration, not deval. I need to make up with cash. And so it became cash return on a bond versus inflation. There was no other metric. And I think we're going to return to that. And that's going to be a very weird, simple world.
And if you think about, at the Bear Traps Report, we wrote a blog called The Cobra Effect. Mm-hmm. And you were an advisor to us on that in terms of, I talked to you about it, and you gave us a lot of great ideas about that. And that was our first look at inflation over a year ago. I think maybe over a year and a half, well over a year ago. And inflation now is proven more, less transitory, more real. Walk us through that Cobra effect and how inflation, when it gets into pockets around the economy, it becomes very sticky. It's hard to get it out. You can't get it out with 1 or 2 rate hikes.
Well, that's true. Well, I mean, the Cobra effect basically states in a very general principle. And by the way, the Cobra effect is an accepted principle of economics. It's not some strange idea. Is that when the government intervenes in markets, it ultimately makes them worse. But the word is ultimately. Initially, it has a positive effect. So when the British Empire decided they want to reduce the number of cobras in Delhi, they paid people to turn in, catch cobras. And then what happened, and indeed, the cobra population went down. But then what happened is people started breeding cobras so they could make more money. And then the British Empire decided, well, they're not going to do that anymore. So what happened to this inventory of cobras? They released them into the streets of Delhi, and there were more cobras than it had ever been, right? So the thing about it is, understandably, the Fed wanted to avoid a depression when the COVID and the response to COVID, the lockdowns happened. So they flooded the world with money and also obviously an equal, if not greater, fiscal response. And this happened all around the world, obviously.
So let's get at some numbers real quick. So it was $10 trillion of fiscal and monetary this cycle versus the post-Lehman cycle, it was about 2.5, 2.6 trillion of fiscal and monetary. In this cycle, the response to COVID was about 10 trillion. So it's almost 4 times Lehman.
Well, it's a fascinating thing about that because, first of all, the worst number I saw during the Lehman crisis for there being a hole in the U.S. banking system was 5 trillion. And so, and what the solution to that was print a lot of money, put it into a lockbox, leave it there, fix the banks. That doesn't cause inflation because
walk us through it. So if you take $1 trillion and you put it into a box,
it's not going to cause inflation.
But why is it in a box?
Because it's not released into the economy. It's buttressing the assets and balance sheet of a bank, but it's not then being sent out to the economy for spending. It's not being spent. So, you can't have inflation without spending, obviously.
So Bernanke, and in that era, wanted to help the banks.
Correct.
When Lehman failed, there was
the balance sheet was a disaster.
Large holes, like you said, a potential $5 trillion hole in all the bank balance sheets.
Right.
And so, by lowering the Fed funds rate and injecting that capital into the banks could take advantage of that. They could borrow,
which they did.
Yeah, borrow in the front, borrow very next to nothing, lend here, and then make that spread over time.
It was the largest wealth transfer in the history of the United States of America from savers, which is to say old people, to banks.
Yeah.
And of course that resulted in this magnificent, bull market that we've had as well. So, but this time, money was given directly to consumers, and they were told to spend it. Why? Because, first of all, the Fed was shocked that the first time around, giving all this money to banks didn't cause lending to happen. They were actually surprised. They were naive. So, but they learned. They said, well, giving the money to banks isn't going to do anything. So now we're going to, let's lower rates and all this type of stuff and buy things and help the banks for sure. But also, they were very, very pro the fiscal response. And so the government gave money directly to consumers to spend. So, and indeed, that averted, there was a recession, but it could have been a lot worse, right? The flaw with that is it also causes inflation. And the flaw with that is really pretty much the only way you solve inflation is with a recession. But the flaw with that is after you've created all this debt, the recession is much worse because it's a recession in many ways is a debt purge. It flushes the financial system out. It brings it back to reality. You create a new structure of financial probity so you can then grow on a more rational, organic plane. So, but that's the cobra effect. They were worried about the cobras. They solved the problem temporarily, and then they had more cobras than ever. They were worried about a recession. They solved that recession, but the recession that's going to come is going to be 10 times worse because there's that much more debt involved. So it's not a good scenario.
To me, it's mind-blowing how many smart people, economists, talking heads, just assume that this post-COVID era would be the same in terms of inflation as because everybody's like, literally the consensus was, we didn't have inflation after Lehman, why would we have it now?
Well, first of all, there's a perfectly logical explanation for it. The money never went into the economy, it went to the banks. That's number one. And that's just, let's make it more extreme. I'm going to print $5 trillion and I'm going to put it on Mars. You think that's going to cause inflation in Poughkeepsie? Probably not. So, but if I send every single person who lives in Poughkeepsie a check, and they're not working, are they going to spend the money? Yep. So very, very, very different animal. But there's another story too, which is when did the bull market in equities begin? It began in August 1982. That's when it started. Didn't start after the crash of 87. Didn't start after the crash. If you look at Lehman, didn't start with the crash of COVID. You look at a 100-year chart on the Dow Jones Industrial Average. Most of these traumatic events that people refer to remembering are barely blips. A couple of them you can see a little jaggedy, but it's straight up. It's geometric price increase from 82. But pre-82, the market went sideways in a wide range. What's the difference? Because you had 20 years of inflation. Stocks couldn't get out of their own ways. And those bear markets, they had half a dozen bear markets in that period. It was brutal. It was horrible. Grown men who'd been in the business for decades were leaving in the middle of the day in tears. Guys who were in their 60s and 70s, done it their whole life. They were crying and trembling in pain. That's a bear market.
Yeah.
It's not a terrible 2 weeks and you get over it. It was decades. It was horrible. That's when I entered the business. I remember, as a young man, looking at people who were like almost my grandfather's age, leaving shattered in the middle of the trading. It was unbelievable, and you don't forget that. So you've really had, in my lifetime, two markets. You had a real bear market during the inflationary era, and you had a bull market in the post-inflationary era. And so the bull market, in my mind, started in 1982. And oh, by the way, that's when Fed funds were at 14% and went down to zero, right? So this bottom that we had and the 10-year at 55 beeps, that's the end of the bull market in rates. Over. We have started and we've been in a bear market that's going to last 30 years also. And what happens to stocks? Nothing good. And so people are looking at 5-year charts, they're looking at 10-year charts, sometimes they're looking at 20-year charts. You need to look at 55-year charts, 75-year charts to understand. Inflation, period, stocks sucked. Inflation taken care of, rates coming in, stocks do great. Well, now that's reversed.
Well, that was great. I mean, I think we've gone almost 40 minutes now, and we covered a lot of ground.
Well, thank you very much, Larry. I appreciate it a lot.
We'll do it again.
It's been fun.
And for those, always remember, the Bear Traps Report works with financial advisors, family offices, hedge funds, mutual funds, pension funds, clients in close to 30 countries now. And it's an institutional platform, but we take our institutional chat, we recap it, so we give the financial advisor, the high net worth individual, a lens on a buy-side conversation. So reach out to us at the Bear Traps Report, Tatiana at the beartrapsreport.com email, and we look forward to seeing you again. Thanks.
Thank you very much, Larry.